Hi there, it's Friday the 22nd of March 2019. I'm Steve Towers. Welcome to ITV, coming to today from Penang in Malaysia. Let's get started. After last week's OECD public consultation meeting in Paris, this week was relatively uneventful in regard to digital taxation. So, what happens next? In regard to the OECD and inclusive framework, the timeline is this. From now to May, there will be a thorough analysis of the public comments made in the consultation. There will be meetings of the Inclusive Framework Steering Group, and a work plan for the project will be drafted. At the end of May, the work plan will be presented to the Inclusive Framework for approval. In June, the work plan will be presented to the G20. From July to late 2020, assuming the G20 approves the work plan, various OECD working parties will undertake the hard technical work. During such work, discussion drafts will be released for public comment. And by the end of 2020, the Inclusive Framework will agree on and make public the final consensus outcomes. Meanwhile, there have been a few developments in regard to unilateral digital taxes. Most notably, the Australian government has decided not to implement a digital services tax. For a copy of the government's press release on this matter, please go to our website or app. In Europe, digital taxes are proposed in Austria, France, Italy, Spain, and the UK. Spain's proposed tax looks uncertain due to the upcoming general election. However, in the other four countries, the taxes look likely to commence. And this week, the Polish Prime Minister seemed to suggest that Poland might follow Austria's lead in regard to an online advertising tax. We shall see. The OECD has published the latest batch of peer review reports assessing compliance with the requirements for exchange of information on request. The peer reviews were conducted by the Global Forum on Transparency and the Exchange of Information for Tax Purposes. 7 jurisdictions were reviewed: Hong Kong, Liechtenstein, Luxembourg, the Netherlands, North Macedonia, Spain, and the Turks and Caicos Islands. This was the second round of reviews for all jurisdictions, and they were all rated as largely compliant. For a copy of the 7 reports, please go to our website or app. The OECD this week hosted the 5th meeting of its Global Forum on VAT in Melbourne. There were 2 key themes for the meeting: the challenges and opportunities of digitalisation for VAT and GST systems, and how to effectively tackle fraud and avoidance. For information about the meeting, including a detailed agenda, please go to our website or app. And the OECD has released the first ever Beneficial Ownership Toolkit as part of its Global Integrity and Anti-Corruption Forum. Now, to be clear, this Beneficial Ownership Toolkit is intended to assist in the identification of the ultimate beneficial owners behind a company or other legal entity, so that criminals can no longer hide their illicit activities behind opaque legal structures. It has nothing to do with the beneficial ownership condition in Articles 10, 11 and 12 of the OECD Model Treaty, despite the same terminology. For information about this new toolkit, please go to our website or app. And there's been another policy paper released on the world's international tax system. It's called Low Tax Jurisdictions and Preferential Regimes: Policy Gaps in Developing Countries, and it's been issued by the World Bank. One of the interesting ideas discussed in the paper is the possible introduction in developing countries of a diverted profits tax, like the DPTs in the UK and Australia. For a copy of the paper, please go to our website or app. I have two cases for you this week. In Kenya, the High Court has reached a decision that you don't see too often. The court has held that the procedures to give the force of law in Kenya to the Kenya-Mauritius Double Tax Treaty were flawed, with the result that the treaty is ineffective in Kenya. The treaty was signed on the 7th of May 2012. The government sought to give the treaty the force of law in Kenya by publishing Legal Notice number 59 of 2014 in the Kenyan Government Gazette on the 23rd of May 2014. The relevant part of Legal Notice 59 is shown here. Please hit the pause button if you'd like to study this slide. Legal Notice 59 was authorised by Section 41 of the Income Tax Act, an extract of which is set out here. Please hit the pause button if you'd like to study this provision. In particular, look at subsection 4. The Minister shall cause a copy of every notice made under subsection 1 of this section to be laid without delay before the Parliament. That requirement to lay the notice before Parliament is also reflected in Section 11 of the Statutory Instruments Act. Subsections 1 and 4 are particularly relevant here. 1. Every Cabinet Secretary responsible for a regulation-making authority shall within 7 sitting days after the publication of a statutory instrument ensure that a copy of the statutory instrument is transmitted to the responsible clerk for tabling before the relevant House of Parliament. And 4, if a copy of a statutory instrument that is required to be laid before the relevant House of Parliament is not so laid in accordance with this section, the statutory instrument shall cease to have effect immediately after the last day for it to be so laid, but without prejudice to any act done under the statutory instrument before it became void. The High Court held that Legal Notice 59 is covered by the definition of statutory instrument, and thus it is covered by the Statutory Instruments Act. The court then said this: it was not shown that the Legal Notice number 59 of 2014 was laid before Parliament, and it is the duty of this court to declare that the said Legal Notice number 59 of 2014 ceased to have effect and became void in accordance with Section 11.4 of the Statutory Instruments Act 2013. Obviously, someone in the government has dropped the ball. Either Legal Notice 59 was not laid before Parliament, which would be extraordinary, or it was laid before Parliament but the government did not prove that fact before the court. So, at the present time, the Kenya-Mauritius Treaty has no legal effect in Kenya, but it should still have legal effect in Mauritius. An interesting outcome. A particular point which should be noted about this case is that it was a public interest case brought by the Tax Justice Network Africa. TJNA succeeded in having the treaty declared to be ineffective in Kenya. However, it appears that the court rejected all of their arguments. The court's point about Section 11.4 of the Statutory Instruments Act was apparently not argued by TJNA. So perhaps an undeserved victory for TJNA. You can make up your own mind. A copy of the decision is available at our website and app. In Australia, the High Court, which is the country's highest appellate court, has refused the taxpayer leave to appeal in the Satyam case, which used to be known as the Tech Mahindra case before the taxpayer changed its name. This is significant. The most recent decision in this case was delivered by the full federal court last year. It held that the Indian resident taxpayer's Australian income tax liability was increased, yes, increased, by the Australia-India Treaty. In other words, the Indian taxpayer's Australian income tax liability would have been lower if the treaty did not exist. The full federal court's decision was based on the clear wording of Article 23(1) of the treaty. Income, profits or gains derived by a resident of one of the contracting states, India, which under any one or more of Articles 6 to 8, Articles 10 to 20 and Article 22 may be taxed in the other contracting state, Australia, shall for the purposes of the law of that other state, Australia, relating to its tax, be deemed to be income from sources in that other state. The full federal court rejected the taxpayer's argument that Article 23(1) should be read down, based on the assertion that a double tax treaty is a shield, not a sword. In dismissing the taxpayer's request for leave to appeal against the full federal court decision, the High Court said there is no reason to doubt the correctness of the full court's decision. So that's the final word on this matter. In China, the government has released Notice 39, which states that the previously announced reductions in VAT rates will be effective on the 1st of April 2019. You'll remember that the VAT rate for manufacturing will be reduced from 16% to 13%, and the VAT rate for the construction industry will be reduced from 10% to 9%. So from the 1st of April 2019, there will be 3 VAT rates in China: 13%, 9% and 6%. For a copy of Notice 39, please go to our website or app. Also in China, a new foreign investment law has been passed by the National People's Congress. It will be effective on the 1st of January 2020, and it will replace 3 current laws: the law on wholly foreign-owned enterprises, the law on Chinese foreign equity joint ventures, and the law on Chinese foreign cooperative joint ventures. For a copy of the new law, please go to our website or app. And also in China, the government has released two items of guidance, Notice 34 and Notice 35, in regard to the tax treatment of non-resident individuals and non-domiciled resident individuals. For a copy of the two items of guidance, please go to our website or app. In India, the big international tax news concerns country-by-country reporting. India and the US have finalised an agreement to exchange CBC reports between the two countries. According to a press release issued by the Indian government, the agreement with the US has now been finalised and will be signed on or before the 31st of March 2019. This would enable both the countries to exchange CBC reports filed by the ultimate parent entities of international groups in the respective jurisdictions, pertaining to the financial years commencing on or after the 1st of January 2016. As a result, Indian constituent entities of international groups headquartered in USA who have already filed CBC reports in the USA would not be required to do local filing of the CBC reports of their international groups in India. For a copy of the press release, please go to our website or app. Also in India, you'll remember that the GST Council recommended GST rate reductions for residential property. Under those recommendations, effective the 1st of April 2019, the new rates will be 5% without an input tax credit on residential properties outside the affordable sector and 1% again without an input tax credit on affordable housing properties. Well, the GST Council has now made a change in response to pushback from property developers. As a transitional measure, developers will be able to choose to continue applying the old rates in regard to properties which are under construction on the 31st of March 2019. However, the new rates must apply for all properties where construction commences on or after the 1st of April 2019. In New Zealand, the government has issued draft guidance on the proposed R&D tax credit, which is intended to commence operation on the 1st of April 2019. You'll remember that the government introduced into Parliament in late 2018 a bill in regard to this R&D incentive. For a copy of the draft guidance, please go to our website or app. In Singapore, the tax authorities have issued updated guidance on the income tax treatment of foreign exchange gains and losses. For a copy of the updated guidance, please go to our website or app. At the present time, it's not clear whether there will or will not be a no-deal Brexit. And if there is a no-deal Brexit, it's also not clear when that would be. The possibilities are next Friday, the 29th of March, the 12th of April, or the 22nd of May. But, as you would expect, EU member states and others are continuing to put in place international tax rules in case a no-deal Brexit does occur, whenever that might be. Recent actions have been taken by the UK, by the European Commission, and by Norway. I'll start with the UK, which has announced two initiatives in this last week. Firstly, the government announced temporary rates of customs duty which will apply in the context of a no-deal Brexit. These temporary rates will last for 12 months. Under this initiative, the duty rate will be nil on 87% of goods imported into the UK by value. Importantly, the nil rate will apply to all applicable goods imported into the UK and not merely those imported from the EU. For a copy of the proposed rate schedule, please go to our website or app. The second initiative concerns the border between Northern Ireland and Ireland. The government has set out its approach to avoiding a so-called hard border if a no-deal Brexit occurs. For a copy of the government's announcement on this second initiative, please go to our website or app. The UK tax authorities have also issued guidance this week in regard to a no-deal Brexit. The guidance concerns the impact on withholding tax on dividends, interest and royalties for payments from the UK to the EU and from the EU to the UK, in the context where the parent subsidiary directive and the interest and royalties directive no longer apply. For a copy of this guidance, please go to our website or app. The European Commission has recently published a series of documents in regard to a no-deal Brexit, a guidance note on customs-related matters, and two related documents, one on business transit scenarios and the other on business export scenarios, a guidance note on excise matters, a guidance note on administrative cooperation in regard to VAT, and Working Paper 962 from the VAT Committee in regard to VAT matters. For a copy of all of these documents, please go to our website or app. And in Norway, which is not an EU member state but is a member of the European Economic Area, the government has also recently published information on the tax impact of a no-deal Brexit. For a copy of this information, please go to our website or app. The European Commission has published a paper on the estimated impact of the CCTB, the Common Consolidated Tax Base, on the effective tax burden of corporations. For your copy, please go to our website or app. And the European Commission has issued another interesting paper this week. This is a draft paper from the EU Joint Transfer Pricing Forum, and it's called The Application of the Profit Split Method Within the EU. Your copy is waiting for you at our website and app. The EFTA Surveillance Authority has decided that Norway's annual cash refund of the tax value of petroleum exploration costs does not constitute state aid under the European Economic Area Agreement. The ESA's press release says this: under the Norwegian Petroleum Tax Act, companies with taxable income can deduct exploration costs, an indispensable phase of petroleum extraction. Petroleum companies that do not have taxable income can carry forward their losses with interest or ask for an annual cash refund of the tax value of these costs. The case was brought to ESA by Bellona, an environmental non-profit organisation, claiming that the cash refund of the tax value of petroleum exploration costs entails state aid from the Norwegian state by giving a selective advantage to certain companies. ESA has now concluded that the measure is not selective. The measure is available to all companies on an equal footing. According to the EEA state aid rules, a measure that is not selective does not constitute state aid. For a copy of ESA's decision, please go to our website or app. In South Africa, the government has published in the Government Gazette the final version of the amending regulations which expand the scope of digital services which are subject to VAT on inbound supplies, effective the 1st of April 2019. You'll remember that the government announced these changes in the second half of 2018. The government also released the final version of the explanatory memorandum and the consolidated regulations after the amendments. Also, as expected, the government has increased the VAT registration threshold for inbound digital services from taxable supplies of 50,000 Rand per annum to taxable supplies of 1 million Rand per annum. For a copy of all of these documents, please go to our website or app. In Brazil, the tax authorities have issued guidance on the tax treatment of payments for technical services and technical assistance paid to a French resident company. The guidance indicates that as the Brazil-France Treaty does not include such payments within the definition of royalties, the payments would be covered by the business profits article, which means that in the absence of a PE in Brazil, the French resident company would be exempt from Brazilian withholding tax. A perfectly sensible result. For a copy of this guidance, please go to our website or app. In Canada, the government has presented its 2019 budget. From the perspective of multinationals, there were several items that caught my eye. Firstly, in regard to the foreign affiliate dumping rules, which are designed to prevent the tax-exempt extraction of surplus when a Canadian subsidiary of a foreign company invests in a foreign affiliate. The budget proposes that these rules be extended to the situation where the Canadian company is controlled by a non-resident individual or trust. In regard to the transfer pricing rules, there are two proposed changes. The first is that the transfer pricing rules will be required to apply before other provisions in the income tax legislation. This will have a number of impacts, including in regard to the calculation of transfer pricing penalties. The second change is to expand the application of the definition of transaction, which currently applies only for transfer pricing purposes. The budget proposes that the definition also apply in regard to the 3-year reassessment period applicable to transactions between a taxpayer and a non-arm's length non-resident person. And finally, in regard to cross-border share lending arrangements, where the arrangements relate to Canadian shares, the budget proposes the introduction of rules to prevent non-resident taxpayers from avoiding Canadian dividend withholding tax on dividend compensation payments made under such arrangements. However, where the arrangements relate to foreign shares, the budget proposes that the exemption from Canadian dividend withholding tax be expanded to include dividend compensation payments made by a Canadian resident to a non-resident if the arrangement is fully collateralized. In the US, the government has released final regulations in regard to regulated investment companies, RICs. For a copy of the regulations, please go to our website or app. And also in the US, The staff of the Joint Committee on Taxation have produced their annual overview of the US federal tax system. This year's effort is a mere 36 pages. For your copy, please go to our website or app. And now for this week's treaty developments. And it's been a slow week. All we've had is one protocol signed. I have 3 articles for you this week. The first article is called Fictional Interest Payments and Abuse of European Tax Law, New State Aid Challenges. It's written by Raymond Lujar and it's published in the Kluwer International Tax blog. This article considers 2 European tax topics and seeks to link them via state aid. The first topic is the recent announcement by the European Commission that it had opened a formal state aid investigation into a Luxembourg interest-free loan ruling given to a company in the Huhtamäki Group. The second topic concerns the recent Danish cases which were decided by the European Court of Justice in regard to the existence of an unwritten EU anti-abuse rule, which is applicable to the Parent Subsidiary Directive and the Interest and Royalties Directive. In regard to the first topic concerning the state aid investigation of the Luxembourg interest-free loan ruling, the author writes this. What is likely to have played a role here in the decision to start the formal investigation is that the Commission saw a case of double non-taxation, as the entity providing the loan was based in Ireland, where it was not taxed on its interest-free loan. So, while Luxembourg did allow for the deduction of fictitious interest in a ruling, there was no such interest recognised and taxed on the other side. But, he asks, why should the non-taxation of the interest-free loan in Ireland have an impact on the state aid position of the ruling in Luxembourg? He writes this. Whether or not the other country's doctrine would allow for taxing fictitious interest should not prevent a member state from determining taxable profit properly in accordance with its national rules, should they generally allow for a deduction of fictitious interest, which the Commission will have to determine in respect of Luxembourg. As long as these rules are internally consistent and the interest rates used reflect what third parties would have agreed to, who is to blame for a difference between national tax systems? And then he addresses the elephant in the room. This leads to another little conundrum. What prompted the Commission not to start parallel investigations in 2 member states, as Ireland failed to include fictitious interest in the taxable income? The second topic concerns the recent ECJ cases on the unwritten EU anti-abuse rule applicable to the Parent Subsidiary Directive and the Interest and Royalties Directive. The author writes this. The ECJ clearly stated that in case of a fraudulent or abusive practice, national authorities and courts are to refuse a taxpayer's claim to entitlements normally offered under the relevant EU legal instruments. This raises the question whether in situations in which taxpayers rely on, for instance, tax exemptions prescribed by the Parent Subsidiary Directive or the Interest Royalty Directive, as in the cases at hand, state aid could be at play if member states continue to allow for such exemptions in some, but not all, situations of abuse. The ECJ's choice of words seems to leave no discretion to national authorities to focus their investigative efforts on the most promising cases. The second article is called "What Constitutes State Aid? Important Factors Companies Should Consider." It's written by Ilaria Palieri and it's published in the Tax Notes International Journal. If you're looking for an article to give you a good basic understanding of the EU state aid treatment of tax rulings granted to multinationals, then this article is for you. The author clearly explains the two key elements of a state aid claim in this context. Firstly, the obtaining of an advantage, and secondly, selectivity. It's the second element, selectivity, which is particularly slippery. The author writes this: when can a measure be considered selective? As World Duty Free and other decisions explain, the ECJ has established a three-step test to ascertain whether a measure is selective. First, identify the normal tax system applicable to the member state concerned, that is, the reference system. Second, assess whether that measure constitutes a derogation from that reference system. In other words, determine if the measure distinguishes between operators that are in a comparable factual and legal situation given the reference system's objectives. Third, if a derogation exists, determine if it can be justified by the nature or general scheme of the system of which it is a part. If so, the measure would not be selective. The author then goes on to explore each of these steps. And the third article is called "In Defense of General Anti-Avoidance Rules." It's written by Frederick Zimmer and it's published in the Bulletin for International Taxation Journal. In the words of the synopsis, this article aims to undertake a critical assessment of the use of general anti-avoidance rules, GARs, in taxation, and concludes that GARs should be considered an inherent and necessary part of income tax rules. The article makes several interesting points. Here's one example. It is sometimes contended as an argument against GARs that they enable tax administrations to base the tax assessment on fictions, mainly because GARs authorise a recharacterisation of the private law transactions, capital gains to dividends, interest to dividends, lease to sale, etc. This view implies that the private legal form is factual and that economic effects are fictitious. Such a perspective can be challenged or even put on its head. In my view, one may more convincingly regard a tax assessment based on a recharacterised private law transaction in line with the economic effects of the transaction as closer to reality, and the private law form chosen by the taxpayer as fiction. Well, that's the way it is this Friday, the 22nd of March, 2019. I'm Steve Towers in Penang. Have a great weekend.